Good day, everyone. So, in the report, we analyzed the overall financial performance of 7-Eleven and Mr. DIY using different segments like profitability, liquidity, efficiency, long-term policy, and shareholder investment. In this conclusion, we will summarize the 4-year pattern and assess how reliable 7-Eleven is as an investment option. For my part, I'll focus from the profitability perspective. In terms of profitability, 7-Eleven's return on equity shows significant inconsistency. The figures fluctuate sharply year to year, indicating that the company's profitability is not driven by sustained operational improvement. In contrast, Mr. DIY maintains consistently high return on equity, supported by recurring earnings reflecting strong operational resilience. The unusually high return on equity in 2023 for 7-Eleven was not the result of stronger performance in its core convenience store operation. It was primarily driven by one-off gain from the disposal of its 75% stake in Caring Pharmacy, amounting to RM 262.8 million. This non-recurring item temporarily inflated profitability and does not represent the company's ongoing earning capacity. In 2024, once the one-off gain was no longer present, 7-Eleven's return on equity declined sharply. This correction reflects the company's true operational profitability and highlights the absence of consistent profit growth. Meanwhile, Mr. DIY continues on a steady upward trend, reinforcing its position as more predictable and stable performer. From an investor's perspective, the key concern is long-term earnings reliability. 7-Eleven's profitability is heavily influenced by irregular non-operational events, which increases uncertainty in future returns. Mr. DIY, by contrast, delivers recurring profits and sustained expansion, making its performance easier to forecast. Okay, thank you. I'll pass to my friend Haziq.
Hello, my name is Dini Hazik bin Yozaran and I am here to explain the liquidity part for this assignment. Okay, let's start with Mr. DIY. So, current ratio indicates whether or not the firm can pay back its short-term obligations using its current assets. So, in the case of Mr. DIY, over the 4 years, it has a very relatively strong current ratio according to its industry standards. So in 2021, it was 2.01 and it increased to 2.38 over the years to 2024. However, in 2022, there was a dip of current ratio to 1.91, and this is mainly due to the expansion project of 180 new stores by the end of 2022. This caused their current assets to decline and their non-current assets to increase due to the investment, and this caused their current ratio to decline. Even though that number is a healthy number, uh, it shows that there's a thinner liquidity cushion, and investors may have concerns as this company is willing to take high risk decisions, and this may raise concerns in the future as Mr. DIY is could be inconsistent and is very volatile. On the other hand, for 7-Eleven, their current ratio is significantly lower than Mr. DIY, starting in 2021 of 0.82 only and increased to 0.88 at 2024. This indicates they have a weaker liquidity and a weaker ability to pay back their short-term obligations. However, in 2023, there was a huge spike to 1.16, mainly due to the company selling their stake of 75% to Caring Pharmacy, which resulted in a cash inflow of 637.5 million, which boosted up their current assets, increasing their current ratio. And the reason for this sale is to give Malaysians a more affordable and high quality healthcare products with Caring Pharmacy and Big Pharmacy. So the reason for these low current ratios is because 7-Eleven operates in a convenience industry. This means there's a high inventory turnover, FMCG, and small ticket and high volume sales. So most of their products are sold via cash, QR, or bank debit cards. So they receive the cash almost immediately. So they do not need high current ratios. So from 2021 to 2024, on paper, it's below 1. However, it does not reflect the company's financial performance since they're still expanding and opening more new stores. There is not a definitive answer for this liquidity part of the assignment due to the industry differences. Although they perform well on their respective regions, investors should base their decisions on the other parts of the assignment. Thank you for listening to my part.
Now, I will be presenting the efficiency perspective of 7-Eleven compared to Mr. DIY, focusing specifically on inventory turnover. Inventory turnover is an important measure that shows how quickly a company is able to sell its stocks and convert into a cash. A higher turnover combined with lower inventory days indicates that a company is operating efficiently, moving products quickly, and maintaining a fast cash conversion cycle. Looking at 7-Eleven in 2021, the company achieved an impressive turnover of 6.09 times, with only 60 days of inventory. This means that on average, their stock was sold and replenished almost 6 times in the year, which reflects very fast-moving operations. The efficiency is largely driven by the nature of their products, which include fast-moving consumer goods like snacks, beverage, and staple groceries. These are items that customers purchase frequently, allowing 7-Eleven to maintain high inventory turnover and keep cash flowing smoothly. On the other hand, Mr. DIY shows a lower turnover rate of 2.52 times in 2021, with much higher inventory days at 145. The slower turnover is mainly because Mr. DIY sells hardware items and household products, which naturally take longer to sell. Additionally, Mr. DIY offers a wider range of products, which increase the complexity of inventory management and can lead to stock sitting on shelves for longer periods. While Mr. DIY operations are stable, their inventory efficiency is much lower compared to 7-Eleven, highlighting the advantage of a fast-moving consumer goods model in terms of operational performance. Now, looking at the trends from 2021 to 2024, we can see that 7-Eleven continues to demonstrate superior inventory efficiency. Their turnover remains high, between 4.74 and 5.21 times, while inventory days stay relatively low, ranging from 70 to 91 days. This shows a consistent ability to move stock quickly, which is especially important in the convenience store business where products can become obsolete quickly if not sold. Even when supply chain disruptions or changes in consumer behavior occurred, 7-Eleven was able to maintain strong operational efficiency thanks to frequent restocking, streamlined logistics, and a data-driven approach to inventory management. Mr. DIY, in contrast, shows slower turnover over the same period. By 2023, the turnover had decreased to 2.13 times, and inventory days increased to 172. This indicates that their stock is moving much more slowly. The slower turnover is expected given the nature of their products, such as hardware items and household tools, which are purchased less frequently. Mr. DIY also has a larger variety of SKUs, which can increase inventory holding times as the company manage different product lines carefully to avoid overstocking and reduce costs. While Mr. DIY showed slight improvement in 2024, 7-Eleven continues to outperform in terms of operational efficiency. Overall, the trends highlight a clear difference in inventory management between the two companies. 7-Eleven's fast turnover and lower inventory days support a quicker working capital cycle, providing operational flexibility and supporting cash flow. Mr. DIY, while showing steady management, operates with a slower moving inventory, which reflects the characteristic of their product offerings. For investors, this efficiency advantage of 7-Eleven demonstrates operational strengths, which is an important factor when considering the company's ability to manage daily operations and respond to market demand effectively.
Hello everyone, my name is Hassan Zahin, and for this segment, I'll be presenting the long-term solvency analysis focusing on the leverage, that is, the ratio of total liabilities to total assets for both 7-Eleven Malaysia compared to Mr. DIY. To begin with, from 2021 to 2024, Mr. DIY's leverage steadily declined from 0.57 in 2021 and 2022 to 0.51 in 2023 and to 0.49 in 2024, which shows a clear trend of reducing debt independence and strengthening the equity base. This steady decrease is a sign of increasing financial stability and lowering long-term risks. In contrast, 7-Eleven Malaysia has maintained a very high leverage from 0.91 in 2021 to through 2023, only dropping slightly to 0.86 in 2024. This indicates that roughly 86 to 91% of 7-Eleven's assets are financed through liabilities, meaning they are heavily dependent on debts, which indicates a high level of debt reliance compared to Mr. DIY. High leverage increases financial risks. Should revenues or cash flows decline, 7-Eleven may struggle to service debt. In comparison, Mr. DIY's lower leverage suggests a better resilience to financial pressure. Based on this leverage comparison, my recommendation if I would have been a financial analyst is to invest in 7-Eleven, but only with caution. Because the company's high debt funded structure increases risk, particularly under the economic volatility, rising of interest rates, or margin pressure. So, if I were an investor, I would consider investing only if 7-Eleven shows a clear debt reduction or stabilizes the leverage further, or I would prefer another company with stronger balance sheet resilience, such as Mr. DIY, or which is similar to that. So that's all for my part. Thanks for listening to us. Thank you so much.
My name is Zihan Zarir Ahmed, and I will be covering the shareholder investment segment and use a comparison of the price to earning ratios of 7-Eleven and Mr. DIY to make my recommendation to a success financial analyst on which company to invest in. I will be considering how the PE ratio is indicative of investors' expectations for potential future growth for the companies and whether that is reflected in the performances of the respective companies. Both 7-Eleven and Mr. DIY have a higher than average PE ratio, where 7-Eleven is at 53.3 times and Mr. DIY is at 24.9 times, compared to the industry average of 17.9 times for the consumer staples sector. This indicates that investors have high expectations of growth potential for both companies, and because 7-Eleven has a much higher PE ratio compared to Mr. DIY, it can be considered that investors have higher expectations for growth. However, this is not reflected in that performance, as 7-Eleven has had slower growth up until in terms of additional stores per year until 2023, where in 2021 to 2022 they had 14 and 45 additional stores annually respectively, but in 2023 there was a large spike to 94 and then 69. This spike is likely achieved from the proceeds of selling a large operating segment, Care Group, which was previously owned by 7-Eleven. They had a gain on disposal of 260 million ringgit, and as it is likely that this is the reason behind the sudden spike in growth, it is unlikely that this growth will be sustainable in the long term. Whereas Mr. DIY has historically displayed higher and more consistent annual growth in terms of the number of stores, wherein from 2021 to 2024, they've averaged at around 170 additional stores per year, with the peaks of 180. As Mr. DIY is more consistent, it is likely that this will be maintained in the long run. And although 7-Eleven may not be sustainable, it should be noted that it is likely that it will have higher relative growth compared to Mr. DIY in the short run, but as it is not sustainable, my recommendation to Success Financial Analyst is to invest in Mr. DIY.
In a nutshell, based on full financial analysis, our recommendation is that Success Financial Analyst Berhad should not invest in 7-Eleven at this peak. Although the company demonstrates strength in efficiency and does show some growth potential, the financial results are highly volatile and significantly influenced by non-recurring gains. In addition, the weak liquidity position and relatively high leverage signal elevated financial risk. And when we compare this with Mr. DIY, which delivers stronger consistency and long-term stability, 7-Eleven does not provide the same level of confidence for a sustainable investment. Therefore, the more prudent decision is to avoid investing in 7-Eleven at this time. Thank you.